And welcome to the Power and Market Report. My name is Albert Liu, and I'm joined today by friend Brian London. He's the editor of Gold Newsletter, the owner of Jefferson Financial, and the president, CEO for almost 37 years of the New Orleans Investment Conference, this year taking place October 12th through 15th. Brian, I don't know if my eyes are deceiving me. 37 years, is it true?
Well, that's how long I've been in the business working in this organization. But yeah, that's how long I've been in this business. Time flies when you're having fun, Albert.
Absolutely, absolutely. You've been having a lot of it, being associated with a conference for so long. I'm really looking forward to it, Brian. Anyone who wants to come, I've already put a link in the description here for this video, so it's as easy as clicking that. But first, tell us what are attendees going to get to enjoy this year in New Orleans?
Well, I think we're at a crucial turning point. We can talk about that a bit, but I think the timing for the New Orleans conference this year is really going to be critical. You know, the macro economic picture is so bullish for gold over the longer term, yet we're not enjoying the kind of performance we expected from the metals markets. And I think that's going to change, and I think that will be evident in about a month and a half or so with the time of at the time of the conference. And our speakers will talk about that. The list of speakers is really extraordinary, Albert. I know you know that, and we have a lot of the great people from last year coming back, and we've added to it a bit. But the experts that we'll have on the stage this year are a lot of the people who are kind of leading the alternative financial media these days. And I refer to it as extraordinary people are rising during extraordinary times. And that's what we have. You know, none of this is normal. So we've got a lot of people out there who are kind of standing athwart history and saying, you know, hey, this is not normal. This is where we're headed. And really counteracting what a lot of the mainstream financial media is talking about. Just some really brilliant minds. I mean, you know them all, but we've got like Jim Grant, of course, Doug Casey. We've got Jim Arurio, Dave Collum. We've got you as one of our MCs. Again, really appreciate your help with that. We've got George Gammon, John Najarian, Tavi Costa, Lawrence Lepard, Dominic Frisby, Adam Taggart, Adrian Day, Rick Rule, Jim Rickards, Brent Johnson, Danielle DiMartino Booth, Peter Bookvar. The list just goes on and on and on. There are literally dozens of today's top names all in one place. So it's going to be a great event. I know you're looking forward to it. I'm looking forward to it. And there's really nothing else like it.
Absolutely, Brian. And so when you talk about, really interesting times, what sticks out to you? I know I tend to take a negative slant, which Rick sometimes gives me a hard time for. But I am the moderator of the boom bust. I kind of see things in those terms. A lot of the prosperity as well as a lot of the pain has been delivered compliments of the Fed. I mean, it's hard to deny.
Yeah.
But what do you see as being different this year than, say, compared to last year?
Well, it's all coming to a head, isn't it? Everything's moving more quickly than ever before. And although we've seen it over the last few years, we're seeing a situation where it simply mathematically has to come to a head. You know, the Federal Reserve is trying to raise rates, yet this mega trend of really 50, 60 years of deficit spending and that deficit spending being monetized by the central bank is really coming to the point. It's really in the end game at this point. The debt has grown so large that Jerome Powell doesn't have the tools that Paul Volcker had. Jerome Powell literally cannot raise rates much higher than they are right now without absolutely cratering the federal budget, without doubling the deficit and overwhelming spending in any other budget categories, including defense and entitlements. So they're about to run into this brick wall. And one of the things people don't realize is that the interest paid on the federal debt on an annual basis has already risen to $600 billion a year, to a record level, never been this high before. And the line is headed straight for the sky. those numbers are calculated quarterly, so we don't have the bulk of the Fed's rate hikes actually calculated in those numbers, and those still lie ahead. So I think that within the next month or two, we're going to get this becoming the dominant or one of the dominant investment themes in the markets out there that everyone's talking about, but nobody's really seeing it yet. I've been trying to publish the charts from the Federal Reserve website, but not getting a lot of traction. Everybody's kind of ignoring this brick wall that lies straight ahead in the Fed's plans.
Yeah, and a lot of the sentiment is actually driven by what we're seeing in prices, and a lot of those prices are driven by
Yeah.
forward guidance, not real hard action by the Fed, but just guidance. And last time you and I saw each other, so that would have been at the Rule Symposium in Boca Raton, stock market was going up, and so you could kind of feel
Yeah.
like people how quick people are to forget uh, how serious the problems are. And then eventually the thing rolls over and we're back to where we started. So what do you think about the rest of the year? Are we going to be doing this like up and down, up and down? Are people going to forget every time someone hints that maybe there's a pivot, maybe there's a good economic result that comes out, quote, good, whether it's jobs or GDP or something like that? Are people going to forget how serious the problems are and then just march ahead, bidding the stock market up to new highs?
Yeah, it's trying to train an old dog with new tricks, really, and you can't blame the markets too much. None of the traders out there, and especially none of the algorithms that are driving trading today, have ever seen a situation like this before. They've never seen inflation, and they've all been born and worked during an era where there was a Fed put, and that whenever we got into any kind of a serious trouble or downtrend, then the Fed came in and rescued the markets, and they're still kind of waiting for that. You can see that there's no capitulation in the markets because you'll have 1,000 point down day in the Dow, and then the next day everybody piles right back in, and greed is still there. It hasn't been wiped out. It hasn't been cleansed from the publican psyche yet. So yeah, we're going to have people coming back in greedy, thinking that things have to go back up, and then getting walloped again when the reality of at least the Fed's determination to hike rates comes back into play. But again, I think the Fed is going to have to, if not pivot, they're going to have to stop very soon because the cost of raising those rates is just insurmountable. And I think that is going to be an admission that the Fed's essentially powerless to fight inflation. They can't fight inflation because, again, they don't have the toolbox that Paul Volcker had. Um, that could change things. That realization, that new market consensus that on one hand, we're going to have persistently high inflation, perhaps not as high as we saw over the last few months, but still high inflation. And two, that the Fed has essentially given up in its fight to fight inflation because the size of the debt prevents it from doing so. Then you have a realization that high inflation, no way to stop it. That isn't bullish for equities. That's not bullish for bonds. Maybe bullish for bonds, but it's not bullish for equities. So where is the market going to go? A significant percentage of that risk allocation is going to go into the relatively tiny markets of precious metals and mining stocks and the like. So that is one potential scenario ahead. Um, it's really going to be a tumultuous time. There are a lot of possibilities. I don't think anybody can really figure out with any certainty what's going to happen. But in virtually any of the scenarios going forward, you really want to own gold and silver, especially from today's levels, in my opinion.
Yeah, you talk about so people fleeing to those sectors. It's not happening now, though. And you're the editor of
No.
Gold Newsletter. You've got your ear to the ground on this. What are your thoughts on how the gold market, gold and equities, have performed this year?
Pretty dismal, obviously. I think that there's a lot of reasons behind that. We had the Russian invasion of Ukraine, which sent prices soaring. And I think that when that got past the public fascination after a little bit, and prices came right back down, that downtrend became the story, and it just continued on downward. We did bottom in about the third week of July, right around Rick's conference, and and then we rallied from there, and we just, as we speak, over the last few days, retested that bottom and seem to, at least at this point, be haltingly recovering from a technical support level. I think we're going to run into, Federal Reserve policy drives everything. We have to admit that. So if you're looking for a catalyst for a sustained rebound, you have to have some change in the Fed's thinking. And again, I think that's going to happen over the next couple of months because these interest rates really aren't sustainable, and definitely not further increases in rates.
You did a talk at Rick's conference when you sort of broke down the problem that it really has, how it's really stuck. And I guess one way of looking at it is we're going to get more inflation because the Treasury needs the inflation. I mean, all this talk about we can't have inflation, they really do need it to deal with the debt. The question is, like, how much inflation do they need? Has anyone ever looked at that?
Yeah.
How much do they need?
Yeah, I have. I think pondering this a good bit over the last few months and really over the last couple of decades, it is the age-old prescription. It's the age-old solution, as it were, for debts in human history. Whenever a government or a civilization has overrun its debts, or run them up too high with military campaigns and entitlements, and people don't realize Rome had a tremendous system of entitlements that really drained the public treasury. So the solution was always to debase the currency, create more cheaper denarius or dollars, whatever the currency was at the time. So it's always been used. But my views on that have kind of evolved over the years. I don't think that's really so much a conscious decision as something that happens when their backs are up against the wall and it's the only way out temporarily. It really doesn't help destroy the debt unless you get into a hyperinflationary situation. Where your currency is deflating, the value of your currency is deflating, and you have inflation of, say, 20% a month or something like that. In an era where the dollar is the global reserve currency and the rule of law in the U.S., and we're the leader of the global economy, it's going to be very difficult for us to get into a hyperinflationary environment. And to do any real good in depreciating the debt, you have to have that sustained very high level of inflation for a considerable point in time. You would have to have, for example, 8% annual inflation, kind of the levels we just had over the middle of the summer, for 10 years running to eliminate the real value of, say, half of the debt, because it's a straight line depreciation. It doesn't compound as it would in a growth mode. So if no central bank official is going to choose 8% inflation for a decade to try and lessen the debt load, because they won't be around. They'll be drummed out of office well before then if we have that kind of debilitating inflation for that long of a period. So I think high inflation is more of an effect than an actual cause or a decision or a policy that's enacted to try to depreciate away a debt load. I think it's something that just they're forced to do to meet the bills tomorrow or whatever, or to meet the obligations. They have to print more currency. But I don't know that getting rid of the debt is ever one of those goals that they think about when they're trying to to formulate monetary policy.
Yeah, I guess when I say deal with it, if that's what I said, I don't think I meant getting rid of it. That's never their priority, is to get rid of it. But what about just to make it manageable, Brian? I mean, they need at least a negative real rate, significantly real, I think, just to service it. And they're not finished growing and spending either. So don't you think that has to become a permanent part of our economy, whether it's 5% or 6 or 4, something like that. It just seems like two is not going to get it done at the rate that they're spending.
Yeah, it's really a classic debt spiral. It's the kind of thing that would send private enterprise or an individual into bankruptcy court almost immediately. Think about it this way: we are in a deficit spending mode, and have been for decades. Right now, the debt, I'm not sure exactly what the deficit is annually, but let's say it's $1 trillion. Very soon, at the current rates of interest and the size of the debt, we're going to be paying $1 trillion every year just to service the federal debt. So in addition to, say, $1 trillion of deficit every year, you're going to be adding $1 trillion of debt service costs. And where are they going to get that money? Because they obviously can't pay for it out of current accounts because they're running a deficit to begin with. They're going to print more money. So they're going to borrow more money to pay the interest on the debts that they already have. It's like getting out opening up another credit card account to pay the debts of your last credit card and still spending at the same level that you're doing. So it is a classic debt spiral that would destroy any other enterprise, any private enterprise or private individual. But governments, of course, don't have to operate by our rules. They don't have the option of going to bankruptcy court and having it resolved, and they aren't held to the same standards. So how long can they go on like this? Who knows? But we need to recognize that this is a process that has been in place really since the mid-1960s, since the guns and butter era of the beginning of really significant deficit spending. And we're in the end game of that. We're in the stage where the water is really moving around the drain much more quickly. In post 2008, the Fed reacted with more liquidity and easier money than it had ever done before. And of course, it has in each economic slowdown before, it had to do more and more before. So 2008, it really brought out the big guns. And we had quantitative easing, we had TARP, we had all of these acronyms and fiscal and monetary rescue measures. Post-COVID, that post-2008, they took 4 to 5 years to increase their balance sheet for the Federal Reserve through quantitative easing and everything else. Post-COVID, they did all of that in the matter of days as compared to years post-2008. So they exacerbated or they accelerated everything to a much greater degree than they ever had before. What's going to happen in the next crisis? What are they going to have to do? Who knows? I don't know. I don't think anybody does. But again, I think you do know that you want to own gold and silver going into that. And at some point in the near future, we're going to face that again.
I remember, I think it was Lou Rockwell, some podcast I was listening to many years ago, and he was talking about Federal Reserve, the governors, the chair, and how they really aren't as independent or even independent at all from the administration. And I think it was Arthur Burns. He was questioned by a reporter once about a decision he's made, and his answer was something like, "If we don't do what the president wants, we'll lose our independence." And that's going back to that era that you allude to. And I firmly believe that that's the case. I don't know who's pulling the strings. It doesn't seem like it would be this president, but someone other than the chairman. And it seems like he's been given quite a bit of permission here to damage the markets if necessary. How far do you think that goes? Because you say he's going to have to turn around pretty soon. How far do you think that goes? How much damage can he inflict on the markets to defend the dollar?
I don't think frankly, I think it's very much due to Powell and the power of his personality. I've talked a good bit about Powell with Danielle DiMartino Booth, who I think is the top expert out there on this very topic. And she holds him in fairly high regard as the best of an ill lot. And so he is, I think he's trying to kill off inflation, and I think he's guiding the rest of the FOMC toward that. I don't think that there's anybody in the Biden administration or virtually anywhere in Washington that has any semblance of fiscal or monetary restraint. And so I don't know that they would be telling him, go ahead and crash the stock market. I think he's doing this despite them and trying whatever he can do to get a lid on inflation. They know how debilitating inflation can be. They lived, most of those people lived through the 70s or saw what could happen. And if not, they read the textbooks and read the histories. So I think they're trying to put up a good fight. And I think they believe that there was enough air in the stock market that it could afford to have a bit let out. But I don't think that they've really calculated the effects on the federal debt and what that means. And I think they're going to find that out pretty soon.
A lot of people for a while were drawing comparisons to the 70s. And then I've heard more people coming out recently. David Stockman's one of them saying, don't bother with that. This is much, much worse than what you saw back then. What they've done is far more damaging than what we saw. And the tools that we have at our disposal to get out of this are not the same. What are your thoughts on that?
Yeah, they are not the same. The tools are not the same. In fact, it's even worse than that. And David Stockman's certainly a breath of fresh air in positivity, but he's absolutely correct on this. The tools are not the same. The tools actually don't exist. Again, there's nothing that they can really do. To fight inflation, you have to do one or two things if you're going to kill off inflation. You have to either raise interest rates above the rate of inflation and have positive real rates. And or you have to kill it from the demand side by killing off the economy. So you can kill off inflation by having a depression, but at this point, that's about what it would take. And they can't get interest rates above the rate of inflation. So that means we are going to have negative real rates for the foreseeable future. There's just no way around it. And those negative real rates are enormously bullish for, metals and mining, in commodities in general, and tangible assets in general.
I want to go through some of the headlines that I clipped, Brian, for this interview. I was trying to find something juicy that we could talk about, but so much of it to me seems like non-news, because the real news is the fact that we are in this conundrum. There's really no way out without a substantial amount of pain, which Powell actually did refer to in a public address, that there's going to be pain. He mentioned it a couple times.
Yeah.
And the news just seems to be kind of a distraction here. But the first headline I have is that the Atlanta Fed slashes Q3 GDP estimate after the data comes out. It seems to me, this is my take on it, is that they like to sort of ease us into the bad news. So whether they knew this was going to be the case a long time ago, many of us were sort of predicting it, right? That we're in a recession, we're going to have the 2 or 3 negative quarters that's coming. They seem to want to be like easing us into it so it doesn't seem as bad. What are your thoughts on that?
Yeah, I think they do. I think the Atlanta Fed GDP now number is service is really great, but a lot of people don't understand it. It is the accumulation of the data, the economic data flow. So early in the quarter, the indicators come in, and whatever estimate is they come up with from that is dependent on all the data to come. So it's very inaccurate. And what happens with that number is early in the quarter and even midway through the quarter, it's really inaccurate, but it starts to vector in and get more accurate and closer to the bullseye as all the data comes in. So it really doesn't bear much watching until toward the end, like we're getting right now. This month will be the clincher for third quarter. As far as the accuracy of that number. So we're starting to make more and more sense. But yeah, I don't know that again, that the Federal Reserve, which doesn't really like accountability, likes that Atlanta Fed GDP Now service. And I think that thing kind of exists despite the bureaucracy. By the same token, you have the St. Louis Fed's great charting site, data site, that I think you just put enough bureaucrats out there and pay them. Eventually, they're going to come up with something to do, although a lot of them don't have anything to do. So those are the two great things in my mind that the Fed actually does with their army of bureaucrats and economists. But then again, they do try to hide things. If you look at M3, they stopped calculating that because they wanted to save money,
Right.
and it was a waste of time. So something that took one economist 45 minutes to calculate, once a month, um, they cut that to save money because they didn't. Now, obviously, that was an indicator that they didn't want out there any longer. So that was pretty transparent.
Yeah, too many questions about it, and it was
Yeah.
a time when the money supply was exploding. So it's not important anymore. Another headline: U.S. consumers see home prices falling for the first time since 2020. This is obviously bound to hit the housing market hard if interest rates or the mortgage rates go to 6% and maybe beyond. What are your thoughts on that in general?
I thought I saw something today, Peter Bookvar reporting that, I mean, they were pretty close to 6% already, five and change somewhere. So, and when you look at the fact that they were 4 points lower not that long ago, I think the market's going to crater. Now, we're still in a deficit of housing, but if people can't afford to buy, it doesn't matter. That deficit of housing can turn into a surplus very quickly. There are a lot of factors out there, Albert, that have yet to really impact the CPI and the GDP numbers. There are supply chain issues that are going to go away, and that's going to help inflation. But we haven't seen a wage cost impact yet on inflation. And we're just starting to see that. We haven't seen a real accounting of housing costs. Now, housing is likely to come down in the months ahead, but there is a pig in the python, as it were, in terms of rental increases, et cetera, that never got to the CPI yet, that will still be coming in on a lagged effect. So I think we're going to see a lot of this combined to lower inflation in the months just ahead, but I think we're still going to be 5 or 6% inflation, and we're going to be at a stubborn level of inflation that the Fed really can't knock off, can't knock down.
You mentioned wages, Brian. I want to get your take on this because I haven't really gotten a good answer to where have all the workers gone? Can every business
Yeah.
be short of labor? How is that possible?
Well, yeah, it's crazy, isn't it? And I can think of a few factors that contribute, but maybe not explain it all. I mean, it part of it is the fact that if you pay people to not work over an extended period, then a lot of people forget to work or forget how to work and don't want to work. But there's also a demographic trend that I think is underappreciated these days, that there's a lot of people, a whole generation or a significant portion of an entire generation that is reliant or looking at inheriting the accumulated wealth of their parents. They're going to inherit their parents' home at some point. They're going to inherit their parents' brokerage accounts and everything else. And so they don't really need to work because of the great American experiment and free market experiment or free market capitalism that has built up this generational wealth. So a lot of people are just reliant on that.
And you think COVID was the catalyst for that? Because they
I
were
think it
working
helped it
before.
along. Yeah, I think it helped it along. This was a demographic trend that was in motion for some time, and but I think paying people to stay at home really helped spark that. So you have a certain percentage of people who are still getting some kind of entitlement income, and you have a certain percentage of people who have wealthy parents or parents who are wealthy enough that they feel like they can live on that income or that wealth for some time to come. And you start adding these little percentages, and it starts to add up to something. So I think that's a big part of it. And as part of this, people talk about how can we be in a recession when there are so many jobs out there. Um, my view on that is that it is different these days, and that the classic recession was due to a lack of jobs. And the recession we're suffering through now is more due to a lack of employees. And that the bottom line is there are not jobs being performed that are adding wealth to the GDP either way, whether there are jobs that are going or wanting without anyone to fill it, or whether there are no jobs at all and there are people who want to fill those jobs. Either way, the economy is throttled. So that's really the driving force behind this recession. It's not a lack of jobs, but a lack of willing employees.
Yeah, and the job losses come as you get further in, don't you think? I mean, they don't show up. They don't show up right away.
Yeah, it builds on itself, doesn't it? I mean, if an economy slows down, then the jobs go away. But I think that the spark to this one was that we were coming out of COVID, but there wasn't enough fuel to keep the economic rebound going, and that fuel being willing, capable employees. So if you can't do that, if you can't keep the fire lit, then eventually it's going to start to flicker out. And as it starts to, and as the economy slows down, then instead of jobs being added or being waiting for employees, then those job notices are withdrawn and the jobs go away. And we may be in that stage right now.
Brian, your explanation is not completely satisfying, but it's much better than my alien abduction theory, and that's the best that I've been able to come up with so far because I just can't make sense of it.
Well, maybe alien abduction has a part to play, but just not a big part. Maybe
Right.
it's part of all those demographic trends we were talking about, Albert. So don't give up on it
All
yet.
right, all right, all right. So let's wrap here. But I want to say that I am looking forward to coming to New Orleans this year, and I assume, like elsewhere in the country, things are wide open now. We're going to be able to go, and everyone's going to be able to have a good time in New Orleans.
Yeah, it is. It's completely wide open. It's, knock on wood, I hope we don't have a global pandemic or war, pestilence, or whatever else. But yeah, it is completely open. It will be a normal event. And I think this is the long awaited, the real kind of homecoming for the New Orleans conference. Last year we had attendees, but because of COVID, we didn't have exhibitors. The year before that, we were completely virtual. Now we have everybody coming, and we have not only everybody coming and some of the smartest people around all gathering in the same place at the same time, but we have a situation where we're really at a crucial crossroads in the markets. And I think people absolutely have to prepare for it. I mean, if you don't do anything, you put everything you have at risk. But if you go there, you can also turn this risk into opportunity. There's going to be plenty of opportunities presented at this event.
All right. So that's October 12th through 15th. Link in the description. Brian, thanks for coming on. It's been a while, so I appreciate you coming back on the show, and I can't wait to see you in New Orleans.
Can't wait to see you either, Albert. And thank you so much for emceeing again this year, and looking forward to seeing you just a few weeks down the road.
All right. Take care.
Take care. Thanks so much.